All right, guys, welcome back. We are done with the break. So, yeah, how's the Josh? Okay. All right, all right. So, just confirm the other things, Nana, as usual. Everything else is fine. Yeah, the audio. Is there any lag? See, when I ask you something, everybody has to participate, okay? Not just those few students who always respond. All right. Hello, fantastic. All right, then. Now, so we'll be starting with another new concept that is buyback, okay? Nana, I know that there will be a little bit of monotony for you. Why? Because we are going back to back almost. We're done with 30 pages of concepts and theory. Okay. So this particular financial instruments index is like that. Okay. And this problem you will have only, uh, till we complete index 32. So once we are done with index 32, once we move on to index 109, after that it will be completely problem dominated. Okay. In index 109, we'll be looking at relatively fewer theory as well as the problems will be much higher. So therefore, you guys will be much more comfortable. But when it comes to see, the purpose of these index as well, right? So what is the purpose of index 32? At the beginning itself, we have seen it's all about definitions and concepts, right? So therefore, the theory will be much higher. But when we go to index 109, the theory will be relatively less, and because all the things are defined in index 32 itself, you get it. So therefore, we'll be solving more number of sums. So therefore, there it will be totally opposite to this one. There will be full of problems and problems. That too, little bit of sizable sums where the answers will be running through at least 2 pages and stuff like that. You get the point. So therefore, just you guys need to have that bit of a patience, and I know that many guys will personally love to solve sums, okay, rather than going with plain theory and stuff like that. I'm i'm hoping that I'm trying to make this as much interesting as possible. Okay, how much maximum interest that I can create with respect to FR subject, that I'm doing it. Okay, right, now let's move on. So shall we start? All right, so what is the concept, Nana? Buy back. Okay, so what is buyback? Name itself tells you are buying back. Okay, so you're repurchasing. You're repurchasing what? Your shares only. So when a company repurchases its own shares, we call it as a buyback. So when a company buys its own equity shares from the shareholders, okay, we call it as a buyback. Now, what will the company do after buying back? Very simple. These shares are usually cancelled. Look at the wording here. What is the wording? Usually cancelled, which means there are exceptions where in certain situations it will not be cancelled. Okay, before that, what do you mean by cancelling? You'll eliminate that equity share capital altogether. You understand the point? So the intention behind buyback is generally to reduce the control. Say for example, right now, there are 10 owners, Nana. Your company has got only 10 equity shares. Okay. 5 is there in your control and 3 is there with the others. Say for example, you buy back from them and then you cancel it off. Then ultimately, if 3 is cancelled, your total 10 shares for your company is right now 7 only. Now in 7, if you have 5, then automatically your percentage of voting share has got increased. Are you able to get my point? So mostly that is the intention. Okay. We'll try to understand the logic as well. There are a lot of reasons why somebody will do buyback. I just gave you a basic idea. What can I say? It's like a mm, what a common man will understand. That's what I've told you. We'll try to understand the logics as well. Okay. Okay. Right now, just try to understand buyback. So buyback means what happens where a company will repurchase its own equity shares from the others who are holding it. And usually the moment buyback is done, it will be immediately cancelled. Got the point? Reducing the outstanding share capital. Now, what do you mean by cancelling? Obviously, you are debiting your equity share capital and you're cancelling it out because you're paying money and then you're buying the shares. Na. So therefore, paying money to bank, you're debiting the equity share capital and you'll cancel it out. So thereby, your outstanding equity share capital will get reduced. Okay. So this is what is buyback. Now let's try to understand the logic behind it. Why would somebody go for a buyback? Why would some company go for a buyback? Okay, see here. Ind AS 32 says when an entity purchases its own equity instruments, those instruments are deducted from equity, which means you cancel it out. No gain or loss shall be recognized in P&L. ये तो clear है, ठीक है. All right. So why are you doing that particular buyback? One of the reasons is to increase your EPS, earnings per share. Really? Yeah. How will you calculate earnings per share? Earnings available to shareholders divided by number of equity shares outstanding. Correct? Now, once this number of equity shares denominator gets reduced, automatically what will happen? Numerator being the same, earnings per share. This will increase, na? Because your numerator is same, denominator is reduced. Ultimately, what will happen? Let's say earlier it is 10,000 divided by 1,000, nana. Now you have done buyback. So 10,000 divided by 1,000, how much EPS will be? 10. Now the same 10,000 is there because numerator is not changing, but in denominator it is not 1,000. Let's say it is 500 after buyback. Your outstanding equity shares has got reduced. Now tell me what is the EPS? 20 it is. So your EPS has got increased. Now, so company wants that to happen. You got it? So to increase EPS, they will do buyback. Okay. Another reason, to return surplus cash to shareholders. I've got huge amount of profit, Nana. I want to give it to my shareholders. So what do? I'll say, array shareholders, I want to give money to you. You have my shares now. You give me shares. I'll give you handsome money. I'll pay premium and then I'll buy back. Let's say face value of the share is only 100. I'll pay premium of 900 and then I'll buy back the shares from you at 1,000. So all the surplus money that you have earned is going back to the shareholders. Shareholders are also happy. You're also happy because you're reducing the outstanding capital. You're gaining more control. You're increasing your EPS. You get it? Next. Okay, so this is fine. Why buyback? I gave you the reason. Let me write here. Why buyback? Why buyback? Okay, so I gave you two reasons over here: to increase EPS, to return surplus cash to shareholders. Now, these three why talks about why any gain or loss from this buyback shall be recognized in P&L. Why it should not be recognized in P&L. For that, let's try to understand the reason. Okay, now pretty simple, Nana. First of all, whenever you get any gain or loss because of your buyback, it should not be recognized in your P&L. What is the reason behind that? There are three reasons. 1, 2, 3. I've written the reasons over here. Can you see that? No P&L, no P&L, no P&L. Okay. So these two are the reasons for buyback, and these three are the reasons for why you will not recognize any gain or loss out of your buyback in your P&L. First of all, your equity shares are not fixed assets. You get the point? So if there is a sale of fixed assets or something like that, and if there is any profit or loss, you'll recognize that in your P&L or SPL, to be precise. You get the point? Once it is realized. If it is unrealized, means it will go to OCA. All these things we have seen anyway. Now here it is not fixed assets, it's your equity share capital, so you won't recognize it. Second reason, when company buys back its equity shares, it is not an expense. It is not expenditure. Buying my own equity share capital and then reducing my outstanding shares, is it an expenditure for a company? No. You're just reducing your outstanding share capital, that's all. You're not trying to incur any expenditure in order to manufacture something, in order to do your business. No. So it is not an expenditure. So therefore, it will not go to P&L. Buyback reduces equity share capital, specifically share capital, and possibly return earnings as well as what? General reserve. So therefore, the effect will go there. This will be reduced. Which one? Retained earnings or general reserve. But it will not go to P&L account. Got the point? Because it is equity share capital. Any changes in that, you should never ever touch the P&L account, especially when it comes to buyback. Clear? Right. So usually when buyback happens, what will be the entry? Very simple, Nana. When buyback is happening, what you're doing, you're paying money to the shareholders, existing shareholders, and then you're buying back the shares. So when you're paying money, obviously to bank. So to bank, how much you're paying? 15 rupees, say for example. Okay, your face value is how much? Face value is only 10 rupees, which means you're paying 5 rupees premium. So therefore, face value is 10 rupees. To that extent, you will debit your equity share capital. Remaining 5 rupees, where will you bring from? That's a premium on buyback. Where do you get that money from? You should not get it from P&L. Again, that's what I'm saying. You should not get the money from P&L. That's what we have discussed now here. No gain or loss shall be recognized in what? P&L. Here you are paying extra na, because of buyback. So it's a kind of loss for you, the premium that you're paying. So it should not go to P&L. So you should not be bringing this 5 rupees from P&L. That is what we have discussed here. Okay, why it should not go to P&L? Gain also should not go to P&L. Loss also, you should not be bringing money from P&L. Money should neither go to P&L. Money neither should come back from P&L whenever there is a buyback of shares. For that only we have seen three reasons. One, your equity shares are not assets, so therefore don't treat it with don't treat it with your P&L account. Okay. Second one is Buying back your equity share capital is not an expenditure. So therefore, it has got nothing to do with your P&L. Okay, so then what you will do? If there is any loss in buyback, where will you get money from? Retained earnings or general reserve. That's what is the third point. Got it? Now, so therefore, either retained earnings or general reserve or sometimes security premium as well. This is where you will get the money from. Already security premium will be there, na? Earlier when you have issued equity share capital, na, at that time you would have created security premium. Na? That balance will be there. From that you will set it off. Or some general reserve balance will be there. From that you will set it off. Or retained earnings balance will be there. Credit balance. From that you will set it off. You understand the point? So therefore, mostly it will be loss only, Nana. Very rarely you'll find gain whenever you do buyback, which means what I'm trying to say is that in layman words, I'm saying it is loss. Actual meaning is you'll always pay premium when you try to buy back your shares. Otherwise, those guys, they'll not be able to sell you. They'll not be willing to sell you. You got the point? So mostly any company, 90% of the cases, when they try to buy back shares, they will buy back only at a premium. So when they buy back only at a premium, what you will do, you'll debit your equity share capital because it's going to be no more. Equity share capital will have a credit balance. You debit it, you cancel it out. It goes out of your balance sheet. Correct? Hello? Yes. When you debit it, it is out of its existence, right? So when you're debiting it, always equity share capital has to be debited at its face value. That's what we have done in Ind AS 102 also. 2 equity share capital, 2 securities premium will do. Always equity share capital will credit it at face value, right? When you're issuing equity shares as well. All the premium will go to securities premium. Got the point? Similarly here also, equity you will debit because it is cancelling out, therefore it has to be debited because usually it is a credit balance. So you debit the equity share capital, then what you will do? Extra money, you'll bring it either from securities premium, already balance will be there in your balance sheet because earlier you would have issued, or general reserve or retained earnings. Got the point? Clear? You will never ever bring money from P&L. Be it clear. Okay, I've already explained you the reasons behind that. Even if you don't understand the reasons also, it's fine. At least remember, okay, whenever there is a buyback, we'll not bring money from P&L. Then where will you bring money from? Because most probably you'll pay premium on buyback up and above your face value. At least in this example, it is just 5 rupees. Usually face value will be 100 and you'll be buying back at 1000. There is a premium of 900. So where will you get this 900 from? Securities premium or general reserve or retained earnings. Got it? I hope this entry is clear. Done? Okay. So far, what did we learn? We have learned what is a buyback. Okay, what is a buyback means what? A company repurchases its own equity shares. Okay, what is the purpose of repurchase? Most probably, usually after repurchasing, it will cancel it out, thereby reducing the outstanding share capital. So why would any company do that? To increase its earnings per share. You got the point. And to return the surplus cash that the company has earned to its shareholders. How will you return your money? By buying it from the shareholders. You are buying it from the shareholders means you are giving money to shareholders, right? Obviously, these are all the two reasons why you will buy back. Okay, any gain or loss because of this buyback should never ever go to P&L account. Why? Because the gain or loss on buying back of equity shares, you should not be equating that with an asset because it is not an asset. So therefore, it will not go to P&L. Second, buying back your shares is not an expenditure. When it's not an expenditure, it will not go to P&L. Third, then where will you get money from? Because most of the times when you buy back, you'll be paying premium on buying back up and above your face value. So where you'll get money from? Either from securities premium or general reserve or retained earnings. Clear? So finally, what is the entry? When you buy back, you pay money and then you buy the shares. So to bank. So when you're paying money, there will be money for face value plus premium. So for face value, to the extent of face value, you will debit the equity share capital. Already equity share capital will be having a credit value. Now you're debiting it, it cancels out and it goes out of the balance sheet. Okay, it is removed. Then the extra money where you will be bringing from securities premium or general reserve or retained earnings. So you debit that and your entry is done. Clear? Okay. So which means so far what did we see? What is buyback? That's all we have seen. Why would somebody do buyback? What is buyback? And what will be the entry that we will pass whenever there is a buyback? That's what we have seen. Correct? Now the next question is, in what way this concept of buyback is relevant in context of Ind AS 32? Because still we are in Ind AS 32 only. We did not go to Ind AS 109. Okay, so that we are going to learn. Now see here. Again, same point. I think you should be getting monotony by this time. Ind AS 32 viewpoint, again, is it a liability or equity when you do this buyback? Same stuff. Earlier also same thing only, na? When it comes to contingent settlement provisions, need to find out whether this contingent settlement provision is a liability or equity. That is financial liability or equity. So everywhere you go, you have the constant issue. financial liability or equity, because all the concepts that we are discussing right now, fixed to fixed test, compound financial instrument. Okay, then we have compound financial instrument has got both, okay, financial liability as well as equity. Then we have contingent settlement provisions. Now we have come to the right side. We have started with buyback. In all these cases, always there is a confusion between whether we should treat it as financial liability or equity. Only exception is compound financial instruments, where it will be having both the features, correct? That's when you call it as a compound financial instrument. But till that time, we have the same confusion right now. So the question is again the same. As far as context of Ind AS 32 is involved, whether this buyback, what you're doing, is gonna be a financial liability or equity. That's what we're gonna see. Okay, very simple. To decide that, again, we'll come to the fundamental concept. Does this buyback result in company having an obligation to deliver cash or fixed assets to shareholders? If it is yes, it will be a financial liability. No, there is no obligation whatsoever when it comes to cash payment or any other financial asset delivery. In that case, it is entirely at company's discretion. I don't have any obligation. In that case, you will be classifying that as equity instrument. Now, again and again, don't ask what is the importance of classifying something like that. That you will understand once we go to Ind AS 109. Because based on whether you are classifying something as financial liability or equity, accordingly, your recognition, measurement, accounting, everything will happen. Everything will change. Are you able to get me? That's why it's very important for us to decide whether something is a financial liability or equity. That's why we are doing all this headache. Got it? That's why we are undergoing all this headache. Got it? Now, okay, see here. If a company has a contractual obligation to buy back its own shares at a fixed amount, look at the wording, contractual obligation. So, which means you don't have a choice. 100% you need to buy back. You are committed. So, there is no question of you escaping from this cash outflow obligation. So, when you can't avoid cash outflow, you know the concept. Automatically, it becomes financial liability. Then that obligation is financial liability, even though the shares are equity. Because when you're buying back, you are buying back equity shares only now. So therefore, the form is equity. You are buying back equity shares. But in that process, how will you buy back your equity shares? By paying cash. So when you are committed for that, you have an obligation to pay cash and then buy back. When you have an obligation to pay cash in future, it satisfies the definition of financial liability, not equity instrument. Because to call it an equity instrument, you should not have any sort of contractual obligation whatsoever to deliver either cash or any other financial asset, correct? So therefore, now the concept is, when you have a contractual obligation in future to pay cash and then buy back the equity shares only, even though now it sounds like you're buying back equity shares, but still it will be this situation. The compulsion of buying back your equity shares will be classified as financial liability because you have a contractual obligation to pay cash in future. Got it? Substance over form. Substance over form. The form is equity shares you are buying, but still the situation, if you see it from holistic perspective, it is like where you have a contractual obligation to pay cash. Therefore, it satisfies the definition of financial liability. Are we done with this? Clear? Chalo, fantastic. Okay, now that you have understood what is the context of learning buyback concept with respect to Ind AS 32, we need to find out whether it ends up as an equity instrument or this buyback of so-called equity shares by a company ends up as a financial liability. That is most important. For that purpose only, we are studying this right now. Okay, if this confusion is not there, why would you study all these things? There is no need. Suppose if there is a situation where buyback will always be classified as an equity instrument, then why would I study all these things? Or if there is a situation where buyback is always classified as a financial liability, then why would I study? I'll just tell you a sentence saying that, whenever buyback happens, consider that as a financial liability. Accordingly, we'll do the recognition and measurement as per Ind AS 109. You got the point? In that case, why would I study all these things? You are studying this in depth only because there is a confusion where sometimes buyback of equity shares can be considered as a financial liability. Sometimes it can be considered as a equity instrument. When it will be considered as a financial liability, when you should consider that as an equity, accordingly you have to give the treatment, accounting treatment. For that purpose, we are trying to understand what is buyback, what is the context of understanding this concept in context of Ind AS 32. Got it? And then we're gonna go with examples. Okay, right now we have understood what is buyback. Okay, why a company will do buyback, and why whenever a buyback happens, the gain or loss will not be transferred to what? P&L. You should have nothing to do with P&L. And then we have seen the entry, and also we have understood what is the context of buyback with respect to what Ind AS 32. That we have already seen. We have to decide whether it's going to be a financial liability or an equity instrument. For that, we know the concept. If there is any contractual obligation of payment of cash or any other financial asset, we will classify that as a financial liability. When there is no contractual obligation and everything is happening at the discretion of the company, at the discretion of the company means at the choice of the company, in that case it will be classified as an equity instrument. This concept also we know, right? That's what we're going to learn right now through examples. So many examples you have got. Case 1. Okay, I think one big example I've given. Right, with this example we'll try to have clarity. You guys are ready? Now let's go with this example, Nana. Company sold put option on own equity shares. This we have already seen a question. Writing your own put option means what with respect to your own shares? So put option means you'll have two parties, option buyer, put option buyer, as well as put option seller. This guy is put option seller. So put option buyer will have right to sell, and put option seller will have obligation to buy. So therefore company has got obligation to buy provided if the other party exercises the option in the future date. Okay. Now fair value is 50. Exercise price is 65. So this is the price at which the company has an obligation to buy. Option premium is 5, which the company receives today, and the period is 6 months. So after 6 months, if the option buyer exercises the option of right to sell, then the company has got an obligation to buy at 65 rupees. Today the company receives 5 rupees premium. Now, Ind AS 32 says if an entity has an obligation to buy because it has written put option its own equity instruments for cash or another financial asset, then this will give rise to financial liability. That's what we have seen here. Na? If you have an obligation, yes, it is financial liability. Correct? Why? Because the company has to pay cash, deliver cash, and therefore it's a financial liability. We know this already. But we also know that WKT means we know that equity means no contractual obligation to deliver cash. If there is a contractual obligation to deliver cash, that is financial liability. Yes? Chalo. Now, let's try to solve this particular example. At the start of the period, that is day 1, what happens basically? You will receive 5 rupees. This is from company's perspective only. Always understand who are we? Company. So always it will be from company's perspective. So from company's perspective, you have received 5 rupees. Okay. So what you will do, obviously, when you receive 5 rupees, you have to debit bank. So bank account debit 5 rupees. You have to credit what? Retained earnings. It will not go to P&L. I already told you. Got the point? Any gain or loss when it comes to buyback. Here you are doing buyback only, na? Buyback means in the question, there will not be a direct sentence saying that there is buyback. Writing a put option, what is the context over here? You are buying your own equity instrument. So which means it's a buyback basically. You are buying your own equity shares means it's a buyback. So there will not be a direct sentence saying that it's a buyback. It's a derivative here. Eventually, because of this derivative, in future, after 6 months, once the other option buyer exercises his option, then you have to buy back your own equity shares. So it's a buyback basically. You got the point. Anyways, now, so therefore, I told you any gain or loss will never be going to P&L account. So where it will go? Retained earnings, general reserve, or securities premium. Here I went for retained earnings. Okay. So therefore, bank account debit, you are getting 5 rupees. To what? Retained earnings. Got the point? Yes? Right. Fantastic. So this is what will happen on day 1. Because day 1 only, na, you'll receive the premium. Obviously. Right. So after that, on day 1 itself, now you have to recognize financial liability. Why financial liability? Why? Because in this particular put option, there is a chance that you have to eventually pay cash to buy your equity shares. You understand the point? Of course, you can say that, sir, 100% it will not happen, sir. If the other option buyer, if he exercises his right to sell, then only we have an obligation to buy. Suppose if he lapses the option after 6 months, then we will not have any obligation to buy. Correct? Correct only. But what is the concept? What is the golden rule of this particular chapter? What can happen? Okay. Is there a chance of this happening? Is there a chance of this happening means happening what? Where there is a chance of that guy exercising his option and where there is an obligation on your part to pay cash and buy the equity instruments, your own equity shares only. Is there a chance of that happening? Yes. What is the other side of it? The other side logic is that, can you as a company completely avoid paying cash in future? No, you can't avoid, because if the other party exercises his right to sell, you have to pay cash and buy your equity shares. You can't avoid cash outflow, correct? When you can't avoid cash outflow, automatically it will never be equity, it will be a financial liability. So therefore, in this situation, you have to create a financial liability. You got the point? Now the biggest question is, how are you going to create that financial liability? Now obviously, tell me one thing. When you are creating financial liability is a credit, right? So obviously you have to, liability is a credit balance, right? So you have to credit it. So to financial liability, fantastic. What is the amount that you have to credit? The amount is present value of the future liability, because this will happen after 6 months. Na. After 6 months, how much is the liability that you have to pay? 65. It is not certain, it is not 100%, but there is a possibility that you have to pay 65 rupees cash and then buy your own equity shares once the other guy exercises the option, correct? 65 after 6 months. Today that is not the value, correct? So therefore, today what you have to do, discount it. Discount it for a period of 6 months. Okay. In this case, let's say 10% is the discount rate for 6 months itself. 10% is the discount rate for 6 months itself. Okay. Therefore, divided by 1.10, you discount it, you get it as 59. So 59 is the present value of your future liability. Fine. Liability has been created. What you will be debiting? Again, retained earnings only. You understand the point? Which means, to pay this liability, where will you get your money from? Not from P&L, again from retained earnings. Initially you got money, na? Where did you take that money to? Retained earnings only. To pay this financial liability, where you will get the money from? Retained earnings only again. You understand the point? Now, one student is asking me a doubt, sir. Actually, you have to pay your, you are actually going to buy back, right? So once you buy back, logically speaking, already we have seen a buyback entry to bank, and you'll be debiting the equity, and then for the premium you'll be debiting retained earnings or general reserve or securities premium. This is what the entry is. So generally, when you're buying back, you have to cancel out your equity, right? So therefore you should be debiting your equity. Why are you debiting retained earnings over here? See, the point is, as of now, is it 100% certain that you're going to buy back? No, there is a chance that you will buy back. That chance of you buying back by paying cash is nothing but a financial liability. Again, I repeat, as of now, is there a 100% certainty that you will buy back? No. If that guy exercises the option, then only you will buy back. If he lapses the option, you will not buy back. So therefore, the chance of you paying cash and buying back your equity shares is only a chance. And that chance of you buying back in future by paying cash and buying back your own equity shares is a financial liability. That is defined as financial liability. Therefore, you have created financial liability, and where you will get the money from? You will get the money from retained earnings. So debit your retained earnings, because retained earnings is a credit balance. Na. You debit means you are getting the money out of it. And where you are going to pay that money? Tomorrow, to the financial liability. So tomorrow when you actually make the payment, you will debit the financial liability and then you will credit bank, because you're going to pay cash. You understand the point? I hope you are understanding the logic behind how entries are created. So please don't buy hard the entries, Nana. FR is a lovely subject. My personal favorite is costing. I love costing and finance. Okay, despite that, if I'm in love with FR, it means that the subject is very exciting. Especially I love this particular chapter because it's very exciting for me. Okay, you understand the point? So try to understand the logic. Don't buy hard, don't buy hard. Okay, so first, how this entry is created? You received 5 rupees premium because you're an option writer or option seller. So you have debited bank. Once you have received the money, you should credit what? It will never go to P&L. Okay, that money should not go to P&L. So you credit your retained earnings. Ho gaya. Now coming on to recognition of financial liability, because now you have a contractual obligation in future. You may have a contractual obligation in future to pay cash, to buy back your own equity shares, or you cannot avoid 100% paying cash in future. Therefore, it is not an equity, it is a financial liability. So create a financial liability, recognize a financial liability. How to recognize a financial liability? To financial liability. Obviously, liability you have to credit, right? So what you will debit for that liability, where you will get money from? Not from P&L, from retained earnings. So you debit your retained earnings. Ho gaya. Now what amount you will put here? Present value of your future liability. What is your future liability? The exercise price, because at that price only, you have to pay cash and buy the shares. That is 65. So you discount it for a period of 6 months. I hope you know the basics of discounting. Okay, future value into present value factor, which is nothing but 1 divided by 1 plus r. 1 divided by 1 plus rate of interest, I have taken it as 10%, so 0.10. That's how you've got 65 divided by 1.10. This basics, Nana, at least you should know the basics of your CA intern, Nana. Okay, that's how you've got this 59. Clear? Right, fantastic. So recognizing financial liability at present value, applying ACM method. That is amortized cost method, sir. Amortized cost method, we don't know, sir. Yes, sir, you don't know. Where we will learn, sir, in Ind AS 109. Right now, we are still solving the sum, na, sir, because unless I solve it now, you will not understand the concept of buyback. Are you able to understand? So, do you know 100% the concept of ACM? No. Will we learn in future? Yes. When are we going to learn it? In Ind AS 109. Then what are we doing right now? To whatever extent that is necessary to learn this particular concept of buyback, to that extent we are going to see it now. Clear? Right. Okay. So see here, although shares are not yet bought by the company, okay, although shares are not yet bought, the company has potential cash obligation. Okay, although shares are not yet bought, the company has got potential cash obligation, which means tomorrow in future, if the other guy exercises the option, then I may have a chance to buy. I'll have an obligation to buy, right? Okay, logic behind the entry. Fair value of obligation is recognized as liability with corresponding reduction in equity. Equity means all these things put together also, na? Retained earnings, reserves and surplus. You got the point. All this put together only we call it as equity. So therefore, corresponding reduction in equity. How can you call it as a reduction in equity? Because this is having credit balance, na? You're debiting it, therefore it's a reduction in equity. This is one logic. The other logic, which I've already told you, to pay this financial liability in future, you need to bring the money. So where are you bringing the money from? From retained earnings. I think this logic is easier to understand. You got the point. So whichever logic you want, from that perspective, you can understand, you can decode this particular entry. I hope this is clear. Clear, Nana? Wait, Nana, wait, Nana. Right now, don't ask any doubts because we are yet to complete this entire example. Okay, let me finish off this entire example. After that, you guys can ask me your doubts. Okay, right. Let's continue. Now let's come to the end of the period. End of the period means after 6 months. End of the period means after 6 months. Okay. Okay. End of the period means after 6 months. Now, after 6 months, what's going to happen? Pretty simple, first of all. Here, you remember the concept which I've taught you in Ind AS 16 PP, unwinding of discount. Here you have discounted, na? Time value of money you have discounted because in future you have to pay 65. You have got it down to 59. Right, now you have to add back interest now for this period of 6 months. How much is that? 6 rupees, which is the difference between 65 and 59, right? That's 6 rupees. Now you add. It is nothing but an interest. Okay. So to that extent, your financial liability has to increase, correct? Because your actual financial liability is 65, na. Because you're recognizing it 6 months early, you have discounted it and you recognized as 59. So after 6 months, it will become 65 only, na? So therefore, actually your financial liability should show 65, not 59. Therefore, now you have to increase it. Increase it by how much? 6 rupees. You got the point. In other words, this 59 into that 10% interest, you will get your financial liability. Okay. This is nothing but interest only, na, for a period of 6 months. Therefore, you debit interest cost. Right now. Okay. Now 6 months is done. Now we have come to the end of the period. Now we have already created a financial liability of 65. Correct? Now some of you might be having a doubt, sir. For 65 liability, if we have created means ultimately we might have to pay 65 cash. Correct? Okay. This 65 cash, where are we getting it from? 59 we have got it from retained earnings. 6 rupees you are saying interest cost, which means ultimately it will go to P&L. So no, 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 no. Another entry will put interest cost means eventually it will also be coming from retained earnings only. So here exactly I have written. This effectively goes to retained earnings only. Are you able to get me? Are you able to get me? Right. So this money also will come from retained earnings only. So effectively you are debiting retained earnings only. That's why I've written here. You are debiting retained earnings only. But to understand, I've written interest cost. So this 6 rupees also you will be bringing from retained earnings. You will not be bringing from P&L. P&L you will never touch when it comes to buyback. Clear? Right. So now totally you have created a liability of 65 because already you have created financial liability to the extent of 59. Now another 6. Totally it is 65. So you are ready. You have the money. That 65, where did you bring that money from? From retained earnings. So from retained earnings, you have picked up 59. You have kept that 59 inside a box and that box name is financial liability. Now 65 is ready. Okay. Now, if the other guy exercises the option, I have to pay 59. Sorry, I have to pay 65, and then already I've created the financial liability for 65. Na? I will just debit it and I'll make the payment. Suppose if he lapses, then what will happen? These two scenarios we have to see. So if he exercises, what will happen? If he lapses, what will happen? If he lapses, it is very easy. The financial liability that you have created is no more required. Why? Because there is no more liability now. Once the option buyer, the put option buyer lapses the option, it means that there is no more liability for you. So when there is no more liability, you cancel the liability. How do you cancel the liability? By debiting it. Okay, you have debited the liability. You will credit what? Very simple. To create this liability, where did you get the money from? From retained earnings. How much did you get? 65. Now give it back. So give it back means again retained earnings has to be created. It has to be created. So therefore two retained earnings. Simple. That's all. Easy peasy. Okay. So eventually if holder lapses the option, it's very easy. There is no more liability. So cancel the liability out. So already liability has been created by creating it. Therefore you debit it. It gets cancelled out. Okay. Now what should be created? Very simple. Where did you get the money from? From retained earnings. So it would have been debited by 65. Now create it back. So the money goes back to where it has been taken from, right? Where it has been taken from retained earnings, it will go back there itself. So therefore credit retained earnings. Game over. Clear? Okay. If the holder exercises the option, then what happens? Now this is tricky. Okay, simple. First of all, if he exercises the option, it means you have a contractual obligation to pay cash. So you will pay cash and you will buy your shares. So when you pay cash, what you will do? To bank, correct? Right. So the moment you are crediting your bank and 65 rupees is going out, automatically your financial liability is gone. Correct? There is no more financial liability. You have created a financial liability thinking that in future you have to pay 65. The moment you paid 65, there is no more liability. Now, therefore, liability has to be cancelled. Liability has to be cancelled out. You understand the point? Therefore, debit financial liability to the extent of what? 65. Therefore, debit financial liability to the extent of what, Nana? 65. Clear? And you will credit what? You are paying cash now. Therefore, to bank. So, financial liability debit to bank. That's it. Are you able to understand? Now, once this entry is passed, it means that now you have got your equity shares. After getting your equity shares, after buying back your equity shares, will you keep quiet? No. What did I say? Usually, immediately those shares are cancelled out. How will you cancel your equity shares? By debiting the equity share capital. So you debit your equity share capital. You got the money. What you will credit? Now you people tell me what you will credit, obviously. Don't say to bank. That is already done. Payment is done already. What you will credit retained earnings because you will be getting this money from retained earnings only, na? So you will credit retained earnings only. You understand the point? Hello? You got it? Chalo. Now I'm getting all the doubts. Everybody is asking, sir, why did you credit RE? Why did you credit RE? Why did you credit RE? Okay. I know you guys will get doubt over here. I know that. This is not something, see, I can anticipate everything, guys. I have nearly, I might look a bit young, but I have nearly like 14, 15 years of teaching experience by now. Yeah. So just wait, just wait. I'll be clearing your doubt. I know that's why here I've written why. I know that the moment I write this entry, you will get the doubt. Okay. Chalo, your doubt should be, sir, already we have seen the entry whenever there is a buyback. What is the entry? You will be debiting your equity share capital because obviously you'll be cancelling out your equity share capital. It will show credit balance. You have bought it and you're cancelling out. Therefore, you have to debit it to cancel it out. Okay. And when you are buying, you will be making the payment, say therefore to bank. And when you are cancelling to the extent of face value, you'll debit equity share capital. The other premium extra what you are paying, you should be bringing it from either retained earnings or general reserve or securities premium. That's why you're debiting that, which is nothing but other equity. ये तो ठीक है. It's very clear. But here, what you are doing is you are crediting retained earnings. That too to the extent of 50 rupees. What is happening? Why? Let me add that as well so that you'll get that doubt. Okay, I'll do it now itself. Just a why put dot here. Okay. Which one will go for? I think this is cute. We'll go with this. This is cute. Chalo. All right. Let's keep it here. So it syncs with your question, your doubt. Okay. Why? Why? Because just for a moment, imagine if it is not a derivative where you have written the put option. If you do a normal buyback, what will be your entry? Your entry will be equity share capital debit, return earnings or securities premium debit to bank, correct? To bank, we know that we need to pay 65. You understand the point? We need to pay 65, correct? Now, equity share capital, how much you should be paying? Now, tell me one thing. So, equity share capital debit, return earnings debit to bank, it should be 65, correct? And the balance should go here and here. Did I give you face value over here? Yeah, face value is 50. So, obviously, in this entry, this should be 50. And here you might be thinking that it should be 15 rupees. You should bring it from equity, I mean return earnings, because you have paid a premium of 15, but it is not that. Why? Because you are forgetting a point that we have already received 5 rupees. So when you have already received 5 rupees, effectively you are not paying 65, you are paying 60 only, because here to bank it is 65. Here bank debit it is 5. So the net effect of to bank is only 60. Therefore, to bank should be only 60. So logically speaking, you are paying only 10 rupees extra. You are not paying 15 rupees extra because already you have received 5 rupees. That is the difference between normal, buyback, and here it is option writing. Already you have got 5 rupees. Therefore, effectively you are paying only 60. Okay. Equity share capital, you have to debit to the extent of 50, and return earnings should be debited to the extent of 10. This is the correct entry. Correct? Are you able to understand? Whereas, let us see how much you have debited. You see, you have debited return earnings to the extent of 5 plus 59 plus 6. Total debit is 60. But in reality, you should have debited to the extent of 10 rupees only. Sir, where did I debit 60, sir? You see here, sir. You have created 5. That's why I put minus 5 here. Correct? After that, what did happen? Did you debit 59 over here? Plus 59. Every debit is a plus. Then again, you have debited here. Here, 6 rupees. Sir, 6 rupees interest cost na sir. I told you eventually this 6 rupees also comes from return earnings only. So it is a debit. I have written here clearly. That 6 rupees also you add. So 59 plus 6, 65 minus 5 which you have already received, which means you have debited return earnings to the extent of 60. But according to the actual entry, you should have debited it only to the extent of 10. So you have debited extra how much? 50. That you need to reduce, na? Therefore, we have created to the extent of 50 rupees. This is how the entry comes. This is complicated only, but this is how the accounting happens. This is how the accounting happens. This is many students, even some faculties, they get confused over here. Why this entry is like this? They try to explain it in a wrong way. Okay, but that is not the fact. That's why clearly I've shown the working over here. You got the point? So there should not be any confusion. Okay, again I'll repeat. Usual the entry will be equity share capital debit, retained earnings debit to bank. Normally it has to be 65, but because you have already received 5 rupees, you already have 5 rupees, you'll be paying 65 only. In reality, 2 bank 65 only. That's why we have written the entry 2 bank 65. But logically speaking, how much net is going out? 60. Therefore, this has to be 60. And because the face value to that extent of, because you have to cancel out the equity shares, right? So you will be debiting it to the extent of face value. So face value is 50, which means you have paid only 10 rupees extra. That 10 rupees extra money you will be bringing it from return earnings. So which means return earnings, the net effect should be a debit of 10. Correct? But what did you do? Initially, you have created it to the extent of 5 rupees, so minus 5. Then you have debited it to the extent of 59, present value of the liability. And then again, that interest also you have debited to return earnings only, because that amount also you'll bring it from return earnings. So another debit of 6. Total debit was how much? 60. So you have already debited it to the extent of 60, whereas you should have debited it only to the extent of 10. So you have debited 50 more. So to reduce it, you have to credit it to the extent of 50. That's what we have done here. So if you look at the final effect of this, so what is actually happening? Already retained earnings has been debited to the extent of 60. Now you have created to the extent of 50. So the net effect is retained earnings debit to the extent of 10. Equity share capital you have debited here 50. To bank you have credited 65 here. There you have debited 5. The net effect is 60. Exactly this entry comes. If you look at the net effect ultimately, although we have passed so many entries, if you look at the net effect, it will come back to this one. That's all. This is the net effect. You understand the point? Sir, the net effect is so simple now, sir, but still we have to do something like this, sir. Nearly 4 entries we have passed. Yes, you have 5 entries we have passed. Yes, we have to do like that only, Nana. Even when problem comes, we have to do like that only. But ultimate understanding is this. If the option is lapsed, it's very easy, Nana. Only when the option is exercised, you'll have this headache. That's why I told you. That is the reason I took this example. Only to make you understand how things will be. So again, I'll repeat. On the start of the day, you are getting money. Because you have sold the option, the other party will pay you money. So therefore, bank account should be debited and that money should be taken where to the retained earnings only. It should not be taken to P&L. Therefore, to retained earnings, here it has been credited. So minus 5. Then you have to recognize the financial liability. How will recognize? Financial liability is a credit balance, obviously. So to financial liability. Got the point? Liability is always credit, na? Right? Asset you have to debit, liability you have to create. Everybody knows this. So to financial liability, how much amount? Present value of the future liability. What is the future liability? The excise price which you have to pay in future to buy the equity shares, which is 65. You discount it, you will get 59. So to financial liability 59. Where will you get this money from? From equity only, that is retained earnings. So you debit retained earnings, that is where you are getting money from. It will be showing credit balance. In that money will be there. You debit it and bring the money from there. So retained earnings to financial liability 59, 59. After that, ultimately your financial liability is not 59, it is 65. 6 months back it was 59, the present value. After 6 months it has to become 65 only now. So again to financial liability, because you have to increase the liability to 65. So to financial liability 6 rupees, already 59 is there. 59 plus 6 it will become 65. And that debit also will bring it from retained earnings only. But actually the cost is interest cost. The name is interest, okay, but you have to bring the money from retained earnings only. So therefore I've written interest cost, but actually I'll be bringing it from retained earnings. So therefore retained earnings is again debited by 6. After that, what will happen? You need to wait and see whether he will exercise the option or lapse the option. If he lapses the option, the financial liability is no more. So you debit the financial liability to cancel it out, because already it will be showing credit balance. You debit it, it is gone. And two, where did you get this money from? Retained earnings. So you credit retained earnings and your answer is done. Your job is done. Clear? If the holder exercises the option, then you have to make the payment. You have to make the cash payment to buy your equity shares. Therefore, you will write to bank. And once you make the cash payment, your financial liability is no more. Therefore, financial liability has been cancelled out. It has to be cancelled out. So you debit it to cancel it out. So financial liability debit to bank. Ho gaya? Right? After this, now you got your shares in your hand. Now you have to cancel it out. So to cancel the shares, you have to debit your equity share capital. You will credit retained earnings to the same extent. Automatically retained earnings will be balanced out. How much equity share capital to the extent of face value, how much you debit, that much you credit. Automatically it will get cancelled out. How automatically it will be cancelled out? That's what I've explained you over here with this. Actually, this should be the entry. This much should be the debit of retained earnings, but you have debited to the extent of 60. Therefore, you need to reduce it by 50. Debit has to be reduced by 50. Therefore, you will credit it by 50. You understand the point? This is the explanation. You need not write all these things in the examination. You will debit equity share capital to the extent of what? Face value. Once you are trying to cancel your equity share capital, credit will automatically go to retained earnings. Automatically everything will be done. This is only for your understanding. You should not be doing this in your examination. This is only for your understanding. To understand why I have credited retained earnings, because many people, they don't understand this or they explain it in a wrong way. Are you able to get me? Everybody. Clear? Any doubts you can ask. We're done with the buyback. Any doubts? Chalo, done. Fantastic. Right. Let's go to the next topic, treasury shares. It's a small topic. Let's finish it off fatafat. First thing you need to understand, treasury shares also comes under the second part, where you'll be buying, as a company, you'll be buying your equity instruments from somebody else. Okay. First thing, it is not permitted in India. So what do you mean by treasury shares, sir? Understand the word treasury. Treasury means what? Treasure. if I say I have a lot of treasure of gold, what do you mean? It means I've kept gold in my locker. I'm holding gold with me. So when I say treasury shares, it means that company is holding shares. That is a logic. That is a meaning behind the word title. Treasury shares, which means shares are like a treasure for me and I'm holding it with me. Okay. Company's own equity shares that it has reacquired, which means I buy the equity shares and I get it back and then I hold it without canceling. I hold my own equity shares without canceling. In buyback, what you do, you buy your shares and shares are treasure for you and you cancel it out. But here you buy the shares and then you don't cancel it and you keep it like a treasure. That's why it is called treasury shares. That's why it is not permitted in India. In global, in all the European countries, most of the countries, it is permitted. Okay. Company's own equity shares that it has reacquired but not yet cancelled. That is, you purchase your own equity shares and holding them as investment. That we call it as treasury shares. In buyback, that will not happen. In buyback, you buy them and then you cancel it out immediately. Thereby, you reduce your outstanding share capital. Thereby, you increase your EPS. Here, nothing is happening like that. You buy back your shares, and how the third party is keeping your shares, your company shares as investment. You're also buying your own company shares and you're keeping it as investment. In India, it is not allowed. It means that, for example, Mukesh Ambani or Reliance company, let's put it this way. Reliance company is buying its own Reliance shares from its own other shareholders and then keeping it as an investment in its own balance sheet. You understand what I'm trying to say? So keeping your own shares as an investment in your own balance sheet, that is what we call it as treasury shares. But in India, you cannot show this as investment in balance sheet and can't call it as a financial asset. It is not permitted in India. You understand the point? Then what we will do in India? Accounting is done by adjusting retained earnings. So when you buy your own equity shares, where you will get the money from, again I told you it should not go to P&L, therefore you will be debiting retained earnings. Got the point? So you purchase your own shares, you will be debiting retained earnings and you will keep the shares till it gets cancelled. You got the point? So you don't have the intention of cancelling it out. When the concept of treasury shares comes into picture, what is your intention? Your intention is not to buy back the shares and then reduce your outstanding shares by cancelling out the shares and thereby you want to increase your EPS. That is not the intention. If that is the intention, it will come under buyback. When it comes to treasury shares, the intention is to buy your own equity shares and keep it as an investment. Probably, see, why it is not allowed in India, there is a lot of chance of fraud happening here, Nanana. Because as a company, you know that how you are going to perform in the next year. You are planning this project, you are planning this project, you know that this is going to work out really well. Then what all companies will do if this is allowed in India? What all companies will do? Immediately they'll buy back all their shares today and they'll keep it with them as an investment. They know that they are going to perform well in future because company itself will have the first hand information. And after that only it will come outside. So it will buy back and then it will keep it with them. And thereby next 2 years fully the company performance will be good. As a result, its share prices will be increased. And once it is increased, they'll again sell it back into the external market. After that, the company knows that they're not doing anything bigger. Thereby, once they sell it off in the external market, whoever the innocent public they will buy, they will not get any return. Just imagine what happens if this is allowed in India. Every company, they'll start enjoying the benefits from their own equity shares also. You understand the point? Public will not enjoy anything. That is why it is not permitted in India. I hope you are getting the logic. Okay. So therefore, the intention behind buyback in this treasury shares is to sell it back again. You buy your own equity shares. In buyback, you will cancel. Here, you will buy your own equity shares. You will keep it with you for a fixed amount of time as an investment and then you will sell it back. So therefore, when you buy, what will happen? You pay money. So to bank and you will buy. For paying money, where did you get the money from to buy back your own equity shares? You will get it from retained earnings. Are you able to get me? After that, what you will do? You will keep it like that. Then tomorrow, once you again resell it, because your intention to buy back is to resell only when it comes to treasury shares. So tomorrow, when you're reselling it, you'll again get the money back. So bank account will be debited. Credit, what you will do? Retained earnings only, because earlier you got the money from retained earnings. Now give it back. Got the point? So sale of shares subsequently. I hope you got the difference between normal buyback and treasury shares. Yes, Nana? Please confirm me. Is this clear? Any doubts with respect to buyback or treasury shares? If you have any doubts, you ask me now itself. Clear? Clear, sir. Clear, sir. Clear, sir. Pass was very interesting. Thank you, Nana. Right. Anybody else? Okay. Okay, those who are going to see this as a video lectures in future, if you have any doubt, you try to call to this particular number. Okay, call means you better WhatsApp it so that it will be easy for us to clarify your doubts. I hope till this it is clear, right? So we are done with treasury shares. In next session, we'll go with transaction cost and the other things. Okay, we have transaction cost, then treatment of interest and dividend, offsetting of FA and FL, and we have few more topics to go. After that only, I think share swap arrangement is the last one. After that, we'll go to Ind AS 109. All right. I think one more class, we should be done with Ind AS 32. No, two more classes. One class is for concept and one more class for sums. We have 13 sums to go, na? Right. Chalo, that's it. Let's wind up this session here. Okay. All right, guys. Let's continue. So where did we stop in the last session, Anna? Can you just confirm me? Okay. This is where we have stopped, right? Treasury shares. Okay. All right. Let's continue, guys. Are there any doubts, Nana? No doubts. Okay. Still, if there is anything in case if you get any doubts further in the time, like when you're revising or stuff like that, you guys can always WhatsApp to this particular number. The number is available over here. Okay. Chalo, let's move on. Now we're just left with few concepts when it comes to Ind AS 32. Okay. Let's finish this off and then we'll go for sums. I think we have 12 sums or 13 sums left over. That also will finish it off and then we'll go to the main Ind AS 109. Okay, chalo, let's start with transaction cost. These are all small topics, Nana. We'll just try to finish it off ASAP. So what do you mean by transaction cost? These are additional cost. Incremental means what? Additional, extra, okay? Additional costs that are directly attributable to the acquisition, issue, or disposal of a financial asset or financial liability. So some extra cost, or you can also call it as additional cost, which is directly attributable in the sense directly related to a particular financial asset or a particular financial liability. That's what we call it as a transaction cost. See, say for example, when you're issuing debentures, there will be issue cost. When you're trying to issue equity shares also, there will be issue cost. Sometimes there will be brokerage. Sometimes to get the subscription, you need to take services of some other company. They will charge some commission. So like that, there will be so many costs, okay? Those incidental expenses to raise money through any of the sources, we call it as issue cost. You got the point? Anyways, right. I gave you an example over here. When you buy or issue or sell a financial instrument in the sense it can be a financial asset, it can be a financial liability, or even equity instrument for that matter. Sometimes you'll have to pay brokerage fee, legal fee, stamp duty, transaction taxes, underwriting commission. This is what the commission that I've told you. Underwriting commissions, all these things put together, we call it as transaction cost. Now, what we are going to learn is what will be the treatment for transaction cost. That is what we're going to learn. Okay. But before we get to that, let's try to understand some keywords. First, what is incremental cost? Here we have seen the definition, right? What did I say? It is nothing but additional cost that is incurred when you're trying to raise money. When you try to raise money, we basically call it as financial liability, right? When you raise money, it means somebody is giving you money and eventually you have to pay back. So there is a contractual obligation to pay back. We call it as a financial liability. Financial asset means you try to invest the money. Even when you try to invest also, there will be certain cost. When you try to buy the shares of some other company and stuff like that. Anyways, now let's try to understand. Incremental cost means additional cost which would not have been incurred if you did not involve in that particular transaction. For example, let's see the official definition over here. They would not have been incurred if that transaction has not taken place. Which transaction? Say for example, you are going to issue debentures. If you have not issued debentures, then there is a particular expenditure, like say for example, any sort of for raising the money through debentures, maybe any sort of transaction cost. Okay, that cost you would not have incurred if at all you did not go for raising money through debentures. You understand the point? Say for example, you are running a coaching institute, okay, a CA coaching institute. You took a building. Now you are planning to start CS coaching as well. Got it? Now once you plan to start CS coaching, you know that this building is completely filled up for CS students itself. So therefore what you are trying to do is that you are trying to take a new building, you're trying to hire a new building, or let's say you purchased a new building, whatever it is. Let's say you're taking it on rent and the rent for that new building is 1 lakh. Now you tell me, can I call it as an incremental cost? Yes. Why? Because If at all you did not go for this new CS coaching, if you don't have any plans to start CS coaching, then this particular cost would not have been incurred, correct? Because you have planned to start CS coaching, you are forced to incur this cost. So which means if at all you have not started CS coaching, then you will not be incurring this particular cost, isn't it? Similarly, incremental cost means, so this is incremental cost in this example which I gave you. Similarly, incremental cost means whether it's a financial asset or a financial liability or equity instrument, anything for that matter, that particular incremental cost you would not have incurred if that transaction did not take place. Means because the transaction has taken place, you have eventually incurred this particular cost. Examples I already gave you over here. Directly attributable means they relate only to that specific transaction, not general overheads. Are you able to understand? Not general overheads means, say for example, you have a head office, Nana. You guys have an idea about general overheads, right? Head office, there are 3 particular branches. Okay, building 1, building 2, building 3. Whatever the expenses that you incur in head office, businesses are happening in these 3 buildings, you will try to apportion that to all these 3 buildings based on some suitable basis. Now in that case, all the expenses that are incurred in this head office, we call it as general overheads. But say for example, you are paying rent of this particular building, then this rent is directly attributable to building 1 only. Whereas rent of head office is general in nature. You incur rent of head office for the purpose of work of all the 3 buildings. Therefore, rent of head office is general overheads and it will be distributed to all the 3 buildings, correct? Whereas rent of building 1 is specifically related to building 1 only. So therefore, rent of building 1 is specific overheads. Rent of head office, which will be eventually distributed to all the 3 buildings, are general overheads. You got the point? So here directly attributable means whatever the cost that you're incurring, it is directly related to that particular transaction. They are not general in nature. They are not general overheads. Just now I've explained you what is general overheads and what is specific overheads. Got the point? Okay. Now that we have understood these 2 words, let's try to understand what will be the treatment for transaction cost. Ready? Now, first of all, let's divide this transaction cost into 2. Transaction cost relating to financial asset and financial liability. Transaction cost relating to equity instruments. Now, this answer is very simple. When it comes to equity instruments, what did I say? Everything will go to retained earnings. Anything that you do will be adjusted to retained earnings. Got it? Which will be there in the other equity. So whatever the kind of transaction cost that you incur whenever you issue equity instruments, or when your financial instrument is ultimately defined as equity instrument, then the transaction cost directly attributable to that particular equity instrument will be adjusted in retained earnings. In other words, other equity. It can be retained earnings or general reserve as well. Okay. Whereas when it comes to the transaction cost of financial asset or financial liability, that transaction cost accounting treatment you will not learn now. You will learn in Ind AS 109. Why? Because there are 3 methods through which you will measure you'll account your financial asset or financial liability. Okay. It can be ACM, amortized cost method, FETPL, fair value through profit and loss, FETOCA, fair value through other comprehensive income. Now, you have to choose these methods. There are rules for that, which we will learn in Ind AS 109. First, you will identify the method and then only you will decide what will be the treatment for the transaction cost. You understand the point? So without knowing the method, we cannot decide a treatment for transaction cost with respect to financial asset and financial liability. Therefore, do I know these methods right now? No, I don't know. When will I learn these methods? When we go to Ind AS 109. Therefore, this much if you remember right now, it's enough. Clear? So, with respect to transaction cost for equity instruments, straight away it will be adjusted with what, Nana? Retained earnings, that is other equity. Got it? When it comes to the transaction cost with respect to financial asset and financial liability, that depends upon the method that you use for accounting a financial asset or a financial liability. So what are all the methods that are available? You have ACM, amortized cost method, you have FETPL, fair value through profit and loss, you have FETOCA, fair value through other comprehensive income. Once we decide which of these methods through which we are going to measure a respective financial asset or financial liability, and then we will decide what to do with those transaction cost. Clear? Now, I just gave you an example over here. Suppose you issue share and raise 10 lakhs. You paid 50,000 as brokerage. Got it? So when you issue shares, what will happen? It means that new equity share capital has been created. Equity share capital credit, correct? So to equity, how much? 10 lakhs. Once you issue shares for 10 lakhs, which means you have issued equity shares that certificates, in return you have to get 10 lakhs. But did you get 10 lakhs? No, because out of that 50,000 went for brokerage. Therefore, you received only 9 lakh 50,000. Therefore, your bank account will be debited to the extent of 9 lakh 50,000 only, because you have received 9 lakh 50,000. Balance 50,000 will go to what? Brokerage. And just now I told you, when it comes to transaction cost with respect to equity instruments, it should be adjusted against retained earnings, which will be there in other equity. So equity issue cost, eventually this will be debited for retained earnings. That is 50,000. That will be your entry. Easy peasy. Got it? Any doubts so far? Are we done with transaction cost? So what is that you need to remember with respect to transaction cost? These are all additional costs that are directly attributable to a particular transaction. Got it? With respect to a financial asset or financial liability or equity instrument. Clear? Now, examples for transaction cost: brokerage fee, legal fee, stamp duty, transaction taxes, underwriting commission, and all that stuff. Then transaction cost, how to give the treatment? We basically divide them into two: transaction cost incurred for financial asset and financial liability, and transaction cost incurred for equity instrument. With respect to transaction cost incurred for equity instrument, it is pretty easy. What we'll do, we'll always adjust it with other equity, that is retained earnings. With respect to transaction cost that is incurred with relation to financial asset or financial liability, first we need to decide we are going to do accounting using which method. There are three methods available: ACM, FETPL, FETOCI. First decide the method. After once the method is decided, then only we can decide what we're going to do with the transaction cost, what will be the accounting treatment. You got the point? And I gave you an example. Done. Chalo. Now let's go to the next topic: accounting of equity instruments. Very easy, Nana. Any contract identified as equity instruments, once recorded, after that you will not touch it. Once recorded at initial value, will not be subsequently remeasured. This is not something new. We have already seen this in Ind AS 102. In Ind AS 102, SBP reserve, ESOPs. ESOPs is nothing but equity shares only. Na? You will provide equity shares to your employees, correct? Huh? In ESOPs, what used to be our methodology? First, we'll initially value it at fair value, correct? Yeah, after that, what we'll do? Will we keep on remeasuring? No, we do that when it comes to cash settled SAR, SARS, stock appreciation rights. There we will do remeasurement at the end of every single year. But when it comes to ESOPs, did we do that? No. Once you have done with the measurement, after that, we never remeasure it. You got the point? So ESOPs, SBP reserve, fair value on grant date. Once we have measured it based on fair value on grant date, after that, we never touch it. We never remeasure it just because the fair value is changing. Got the point? Here also, when it comes to accounting for equity instruments, the logic remains the same. Once you have identified a particular financial instrument as equity instrument, that's it. You measure it at your initial value. Once it is measured and recorded at initial value, that's it. After that, you won't touch it. You will not be remeasuring your equity instrument every year. Am I clear? Done. It will not be subsequently remeasured. That's your accounting for equity instrument. So I've written here, let's connect the dots. Why? Because one of the dot, that is the knowledge that you have learned from ESOPs. Anyway, I've written here. So now there is no need for you to connect the dots. Anyway, I have connected it. Okay. So this is not something that is new for us. We have already seen that this treatment in Ind AS 102. Now, coming on to treatment of interest and dividends. This is interesting. So I want you guys to listen carefully. Ready? So what is the treatment with respect to interest and dividends? Now listen carefully. Listen carefully. Suppose there is a financial asset, which means you have invested, or you have purchased debentures of some other company, or you have purchased preference shares of some other company. In that case, what will happen? They will give you either preference dividend or they'll pay you interest. You understand the point? For you, it's a financial asset. For them, it's a financial liability, correct? You have purchased the debentures for example. Then what will happen? Either you will get interest, or if you have purchased preference shares, you will get dividend. You will get the money from them. Therefore, it is income for you, correct? Once you get this income, what is the treatment for this income? Any income that you get from your financial asset, straight away it will be credited in P&L. So you will recognize that in P&L income, therefore it will be credited. Clear? Right. Exactly opposite treatment for financial liability. In financial liability, what will happen? I am the company. I have issued debentures. So every year I have to make interest payment. So straight away, what will I do with the interest payment that I have to pay? I'll recognize that in P&L, which means I'll debit it, because for me it's an expenditure, correct? Same goes with preference dividend as well. Every year I have to pay mandatorily preference dividend. What will I do? It's an expense for me. So therefore it will be eventually debited. You'll recognize that in P&L, whether it is interest or dividend. Got it? That's what I've written here. One of the students at that time only, they've asked me about, sir, when it comes to preference dividend, suppose you are paying mandatory dividend, you may call it dividend, but the nature is in interest. So therefore it will be recognized in P&L only, although it is called with the name dividend, because you are paying mandatory dividend. Suppose it is discretionary, that's a different thing. Once you are paying mandatory dividend, even though the name is dividend, the form is dividend, but the substance is in the nature of interest because mandatorily you have to pay. Therefore, it will be recognized in P&L. That one point you remember. Got it? Coming on to this one. This is interesting. See here. Equity instrument. It will be recognized directly in equity. Whatever the dividend that you pay will be adjusted against other equity. I told you so many times, anything related to equity instrument, it will not go to P&L. Here also it will be debited to retained earnings or general reserve. Here also it will be adjusted in other equity, that is retained earnings. Wherever you see, when it comes to equity instrument, mostly the adjustment will happen with respect to what? Other equity, that is retained earnings or general reserve. Here also, if you have given ordinary equity shares, if you have issued, and for that you are paying a dividend, it will be adjusted against retained earnings or general reserve. Preference shares with discretionary dividend. Preference shares with mandatory dividend will be treated as an interest and it will be recognized in P&L. Preference shares with discretionary dividend will be treated as equity par dividend. Even though it's a preference dividend, the form is like equity dividend only. Therefore, it will be treated on par with equity dividend, which means it will be set off with what? Retained earnings or general reserve. This is where it will be set off, means it will be debited, because obviously this will be showing credit balance and obviously this is an expenditure, therefore you will debit it and this balance will be reduced. Are you able to get me? Mandatory dividend treatment will be in the form of interest. Discretionary dividend, even though it's a preference dividend, treatment will be in the form of equity dividend. Got it? Compulsory convertible debt, sorry, debentures with discretionary interest. Here it is debt, debentures. Debentures means the moment we see interest, we'll try to debit that in P&L account. No, because it is discretionary. Discretionary means here also this interest should be debited to retained earnings or general reserve. Even though the form, the name, the form is interest, it is in the nature of equity dividend. Therefore, it will not be recognized in P&L account. Mandatory interest will be recognized in P&L account. Discretionary interest, discretionary dividend will be treated against, will be debited to retained earnings or general reserve. That is other equity. Mandatory only will come in P&L account. See here, any discretionary payments made from instruments classified as financial liability also. Instrument is classified as financial liability, Nana. In that, if there is any discretionary payment, that will also, you will try to set it off against retained earnings or general reserve. Now you can ask me about why PKSIR. I know this is your reaction basically. You're getting burned up because of too much of depth over here. See, the reason is because the substance of the payment is more like distribution of profit rather than financing cost. Why? Because discretionary interest means what? What do you mean by distribution of profit? Whenever there is profit, you will distribute. Otherwise, you will not distribute. Correct? What do you mean by interest? Irrespective of whether you have sufficient profit or not, you have to pay interest. This is the basic difference, correct? Distribution of profit is nothing but equity dividend generally. Okay, when you will distribute your profit? When there is profit. If there is no profit, will you distribute? No. What about interest? Normal interest I'm talking about. Irrespective of the profit, whether you have profit or not, anyway you have to pay interest, correct? Now here what you're doing, name is interest only, but it is discretionary, which means are you paying interest right now irrespective of your profit? Anyway, your situation is mandatorily, are you paying interest every single year? No. When you have sufficient money, you will pay interest. When you don't have sufficient money, you will not pay interest. So therefore, it is in the form of what? Equity dividend only, na? Just like discretionary, because it is discretionary in nature. Just like distribution of dividend or distribution of profits. You understand the point? Therefore, even though the name is interest, it seems like a financing cost, but the nature is not financing cost. The nature is like equity dividend or distribution of profits. Therefore, that's why even though the instrument is classified as financial liability, still the so-called discretionary interest will be debited to other equity, that is retained earnings or general reserve. Now, another doubt is, okay, sir, why the instrument is classified as financial liability when you're treating the discretionary interest as what? On par with the equity dividend, where you're trying to debit it to what? Retained earnings or general reserve. For that also there is an answer. Because due to some features like redemption obligation, your interest may be discretionary, but your redemption obligation will be what? Compulsory. In that case, it becomes a financial liability, obviously. You understand the point? Still, this interest aspect alone will be what? Exactly. It will be debited against retained earnings or general reserve. You understand the point? It is just like a compound financial instrument. That case also it will happen. That case also it will happen. You got the point? Exactly. One more exception. This already we have seen. Borrowing cost, Ind AS 23. Borrowing cost with interest for qualifying asset. What you will do? You will capitalize it. You'll add it to the cost of the qualifying asset. Na? Means if some other standard specifically says something that this is what you do with the interest, then you follow that particular standard. Borrowing cost is nothing but interest only. Na? So what you need to understand is that if some other standard specifically tells you something that with respect, for example, only I gave you borrowing cost, that this interest, if these conditions are satisfied as Ind AS 23, I'm specifically telling you that this has to be capitalized. The borrowing cost has to be capitalized with respect to qualifying asset. If I say borrowing cost, you will not sync with it. Let me call it as interest. So if some other standard is specifically giving some particular treatment, if the standard is specific, then Ind AS Ind AS 32 says follow that particular standard. If all the other standards are silent, then in that case, by default, you follow this particular standard with respect to what? Interest payments. All right, guys, let's continue. So this is where we have stopped. One point, some students have got doubt with respect to this one. That's why now I've clearly written in brackets that I'm talking about compound financial instrument. You have a financial liability as a part of compound financial instrument. Okay, got it? I hope that doubt should be cleared now because I've written this in brackets. That's fine. Let's move on. Now moving on to the next concept. What is that, Nana? Offsetting of financial asset and financial liability. Offsetting means if one is a asset, one is a liability, you try to set it off. Normal assets and liabilities, you can't do that. But when it comes to financial asset and financial liability, you can do that. But this is just presentation purpose, Nana. There is no other motto over here. It's not accounting purpose. It is just presentation purpose. That's the first thing you guys need to understand. Anyways, shall we move on? Yeah. In balance sheet, any asset and liability cannot be presented on net basis unless you can't present it on your own unless if any Ind AS permits you to do so, yes, you can. There are certain assets and liabilities where Ind AS specifically says that yes, you can set it off. In that case, we can do. For example, Ind AS 37 is there, which we haven't covered so far. We will cover it. Provision can be presented net of reimbursement. That once we go to that particular standard, you'll understand. Right now, we haven't covered it, so you guys don't have an idea. Ind AS 20 government grants, where grant related expense and government grant can be presented net. So this is based on common sense also, you can understand. No need to even study this particular standard, although we haven't covered this as well. But just look at the sentence. Grant related expense and government grant. You're getting a grant from the government. To get it, you have a related expenditure to get it. Okay. Then obviously you'll set it off, right? So that is allowed in Ind AS 20. So if any specifically Ind AS allows you to set off an asset with a liability, you do that. Otherwise, on your own, you should not do anything. Got it? That's what the ultimate concept is. Now, applying that logic, an entity shall offset financial asset with financial liability only when both of the following conditions are met. Okay, these are all examples where we are trying to say that you cannot just set off an asset with a liability on your own unless an Ind AS allows you to do so. That's what we have seen right now. Okay, now our topic is not about normal assets and liabilities. Our topic is about financial asset and financial liability. So therefore, when it comes to financial asset and financial liability, can you set it off? Can you offset that? Yes, you can, provided two conditions are satisfied. What are they? First, it should be a legally enforceable right. Second, intention to settle net should be there on both the parties. In the minds of both the parties. Okay, let's put it that way. You got it? So first one is what, Nana? Legally enforceable right. Which one? The so-called set off. And intention to settle net. If these two conditions are there, if these two conditions are satisfied, yes, you can present by setting off your financial asset with financial liability. Am I clear? Okay, let's go with an example. I gave you a real life example over here. Because in your ICA study material, I did not find a proper example. Now let's go with real life example. This has happened in reality. Okay, HDFC Bank enters into a derivative contract like interest rate swaps, currency forwards. Currency forward means in future you'll try to enter into a future kind of a contract. It's a forward contract where at a particular price you'll try to buy the currency or you try to sell the currency. You understand the point? With a bank, obviously. That's what we call currency forwards. Already we have seen an example, Anna. For forward contract, the first example we have seen is based on currency only. Currency forward only we have seen while discussing the concept. Okay. The other one is interest rate swaps. Interest rate swap, right now you don't have an idea. Anyway, we're going to see an example going forward. It is like, see, there are two types of interest, Nana. Floating rate interest, fixed rate interest. Okay, so swap means you will just exchange. Suppose you have a floating rate interest, you will swap it with fixed rate. You have a fixed rate interest, you will swap it with floating rate. Right now, you will not understand what I'm trying to say. At least, I hope you know the meaning of the word swap. Okay, why somebody would do that, why somebody would swap like that, all those logics we'll see later, because right now that's not the point under discussion. Okay, right now what is the topic under discussion? Financial asset set off with financial liability. That's what we're gonna see. Clear? Okay. HDFC Bank enters into a derivative contract. It can be interest rate swaps. What is that? We'll see later. It can be currency forward. That's the first example that we have seen when we have discussed forward contracts. Okay. With other financial institutions, say ICICI Bank. Okay. HDFC enters into derivative contract with ICICI Bank. Fine. These contracts result in receivables if HDFC is in the money with because it's a derivative contract. So one party will be in the money, other party will be obviously out of the money. See, try to understand one thing. Yeah. See, in stock market, you have different types of people trading. Okay. There are some people who are called investors. There are some people who are called swing traders. And there are some people who are called just traders or day traders or scalpers for that matter. Now, what you guys need to understand is when it comes to investors, it's a safe game actually. You and me, anybody can do that. Okay, you can just do fundamental analysis of any company. Try to see how their financials are. Try to look into some figures probably, profit over a period of time, sales over a period of time and stuff like that. And eventually decide whether a company is healthy or not and try to invest and then forget about it, at least for 1 year, 2 years in the long run. So then wealth gets created. Suppose if a market share price of a particular company where you have invested is, say for example 200, it goes all the way up to 300, say for example in those 2 years, then that extra 100 rupees wealth is created for the first time. So everybody enjoys. Got it? Same goes with swing trading also, because in India anyway short selling is not allowed. Swing trading means you will try to buy at a low of the swing and then you will try to sell at the high of the swing. Usually these people will be in the trade for a month or 2 months or 3 months, sometimes maximum 4 months or 5 months, half a year max, that is. Long term investing, it will go beyond years, but swing trading, it will be few weeks sometimes and as high as a quarter, 3 months, 4 months max. After all these, we have something called options, futures, and we call it as derivatives, derivative trading. Now, when it comes to derivative trading, why many people lose money here is because it's a zero-sum game. When I say zero-sum game, it means in swing trading as well as in investing, wealth gets created, so everybody makes money out of it because money is getting created. But when it comes to derivatives, money never gets created. It just moves from one pocket to another pocket. For example, if somebody is making, let's say 1 lakh in derivative, then 100% somebody has to lose 1 lakh on the other side. Then only you will earn 1 lakh. That's the ultimate concept of derivative trading, whether it is options or futures or anything. It's a zero-sum game. We call it as a zero-sum game, okay? That is why here, when I say HDFC has got receivables and if HDFC is in the money, you understand the point? Then definitely the other party with whom HDFC has entered into the derivatives should be out of the money, right? Suppose HDFC is out of the money, which means out of the money means I have already explained you this. Eventually, you are about to face loss. It's not certain. It's most probable that you are about to face loss. You understand the point? So in that case, if you are about to face loss means the other guy will be making money. He will be in the money. So if HDFC is out of the money, ICICI will be in the money. In that case, HDFC has to pay money to ICICI because ICICI is in the money. You got the point? Because when it comes to derivatives, it's a zero-sum game. One has to pay to the other. If one is making money, definitely it has to come from the pockets of the other. You understand the point? So therefore, if HDFC is out of the money, then why it is called payables? Because HDFC has to pay to the in the money ICICI. If HDFC is in the money, what does it mean? It means ICICI is out of the money. Therefore, ICICI will eventually pay to HDFC. Therefore, HDFC has got receivables. You got the point? Fantastic. Now suppose HDFC has a receivable of 500 crore from ICICI. They have entered into some derivative contracts where HDFC was in the money. Therefore, it has to receive this much from ICICI. At the same time, there is 450 CR payable to ICICI as well. There are some other derivative contracts because they'll not enter single derivative contract. These are all big companies. They'll enter into multiple derivative contracts. And derivatives is like a betting, right? So therefore, in few contracts, HDFC has won. Therefore, HDFC has to get 500 CR from ICICI. In few derivative contracts, ICICI has won. Therefore, HDFC has to pay 450 CR to ICICI. Ultimately, now what these two, eventually banks will do? two banks has a legally enforceable master netting agreement. There is something called master netting agreement, Nana. It's legally enforceable. Ah, exactly. Because that is one of the condition, Nana, to offset financial asset with financial liability. You understand the point? Ah, exactly. You get it? Okay, okay. Right. Anyways, so there is a committee called ISDA, International. I'm coming to that only. Okay. International Swaps and Derivatives Association. Okay. There is something called International Swaps and Derivatives Association. They manage all these things. So this is legally enforceable, master netting agreement. Okay. So now these guys, because this is legally enforceable and because both the parties have agreed to each other, therefore both the conditions are satisfied. Because both the parties have agreed to set nettle means there is intention to settle net. So therefore both the banks intend to settle the net amount. Therefore can I present, now HDFC, can it present in its financial statements by netting of financial asset with financial liability that 500 and 450? Yes, it can. Why? Because it's legally enforceable with the help of a master netting agreement, and ISDA oversees this, International Swaps and Derivatives Association, as well as both the parties has got intention to settle net. Okay, yeah, no problem. That's it. You got it? So this example I gave you only to understand, that's all. Okay, just have an idea. Okay, if these two conditions are satisfied, this is a real life example which I gave you. In that case, of course, you can present. This is only presentation purpose. Here also I have written. Where is it? Offsetting of financial asset and financial liability is only presentation purpose, Nana. It is not for accounting purpose. Keep that in mind. Purely presentation. So that your presentation will be simplified. That's all. Nothing else in that. But to do that, these many conditions has to be satisfied. Got it? Chalo. I hope this one is clear, Nana. Let's move on to the next one. Foreign currency convertible bond. FCCB. I think I already gave you a basic idea with respect to this one long time back, if I'm not sure. Right, I'm not sure about the time, but definitely we have touched upon this particular concept. Anyway, now we'll try to go in detail. So what is this foreign currency convertible bond? Very simple. The bond will be issued in foreign currency by an Indian company to foreign investors. Okay. Because to attract the foreign investors to invest in it, obviously I have to give the same in foreign currency. So therefore I'll do that. And you know that because of this, what will happen? Obviously, you will be having this foreign currency risk, right? So let's try to understand what this bond is all about. This bond is issued in foreign currency. Mostly it will be in US dollars, Nana. In some rare cases, it will be euro. Issued by an Indian company to what? Foreign investors. This we already know. It pays interest like a normal bond. It also gives the bondholder the option to convert the bond into equity shares of issuing company at a later date at a fixed price. This is the new twist. Till here, everything is fine. See, normally what is bond? Basically, it's like a debt only, na? I, as a company, I give you a sheet of paper, you give me money on that behalf. Okay, I take your money, I use it for my company, and eventually, because you have given me money, I'll keep on paying you interest from time to time. This is what we call it as debentures or bond or whatever it is. Okay, then after that, after one particular point of time, I'll try to repay back your money, right? That's what we call it as redemption. Or I convert that into some specific number of equity shares. Are you able to understand? Now, this conversion can be with any sort of, a twist in the tail, like in the sense, it can be compulsory convertible debentures or compulsory convertible bonds where I'll be 100% for sure. Without your permission, I'll be converting that into, equity shares. And then I'll be issuing you the same converted equity shares, right? Or the option can be given to you and you can choose whether you want the bond to be redeemed or you want it to be converted into equity shares, or the option can be in my hands. If I want, I can redeem or I can convert that into equity shares. So any of these possibilities can happen, correct? Anyways, here what is happening is that this foreign currency convertible bond, I have issued the bond in foreign currency to the foreign investors by the Indian company, and just like any other bond, I'm just paying you interest. However, when it comes to the redemption, I'm not going to redeem the bond. I'm not going to pay you back the money. Instead, I'm going to convert that into equity shares. Equity shares of what? My company. My company means which company? Indian company. Indian company means obviously those equity shares will be denominated in what? Indian rupees, correct? You understand the point, obviously. So that's where a little bit of a problem comes. Let's try to see how we're going to deal with it. Okay. Let's take an example to understand this. Issued a convertible bond in foreign currency. Okay, obviously it's a foreign currency convertible bond. Let's say fair value is $1. You got it? Face value is $1. Okay, face value is $1. You have two cases. Let's try to understand both the cases over here. On 10th year, your promise that you're gonna convert this debentures into bonds. Sorry, convert this debentures into what? Shares. Okay. Now, debentures will be converted into equity shares, and it was clearly told at the beginning itself that one equity share is equal to $0.25. That is the issue price of the share. Now, when one equity share is $0.25, then how many shares has to be given? Very simple. Value of one debenture divided by value of one share. Value of one debenture is how much? $1. Value of one share is how much? $0.25. Therefore, for every debenture, you have to give what? 4 shares. Pretty simple. So initially the amount that you have received, from the investors, that is also fixed. Investors paid you fixed money, and now also you are giving them back fixed number of shares, because how many debentures are there? Into 4 will be the number of shares that you are going to give. Therefore, fixed to fixed test is passed. Therefore, it will be designated as equity if fixed to fixed test is passed. Obviously, equity instrument. However, look at case 2. This is tricky. This one is pretty normal. Okay, there is no confusion over here. In the 10th year, obviously your debentures will be converted into equity shares. However, it will be converted into equity shares at rupees 20 per share. Try to understand this sentence. Debentures will be converted into equity shares at rupees 20 per share. Now, how many shares need to be issued? We have already decided that value of a particular share is 20. One share is 20. In that case, I need to find value of the bond on that particular date. I know value of the bond in dollars. It is $1. But here I gave value of the share in rupees. Now, how can I match these two? I need to take the exchange rate on that particular date. Now, I don't know what is the exchange rate is going to be after 10 years, correct? It can be 80 rupees, $1. You can find $1 in 100 rupees. You can find $1 in 60 rupees as well. If it is 80 rupees, then what will happen? $1 into 80. So, the debenture value will be 80, whereas your shares value is 20. Therefore, for each debenture, you will give 4 shares. If the dollar value is 100, then one debenture value will be 100. And anyway, your share value of fixed, which is 20. Therefore, you will be giving 5 shares. And if $1 is 60, say for example, in the future date, in that case, it will be 60 divided by 20, which means you'll be giving 3 shares for every one debenture, because one debenture value is $1. Got the point? Now, usually looking at this, we shall say that obviously there is a chance of variable shares because of this sentence, and as a result, fixed to fixed test is failed. Logically speaking, correct only. However, there is a carve out point. Carve out means what? International AS, IAS or IFRS says something different, and we Ind AS, we say something different. IAS 32, that is International Accounting Standards, they say that it's a financial liability. This kind of a situation where fixed to fixed test is failed. You understand the point? However, Ind AS 32 says it is equity because issue price is fixed, it seems. So far, we have clearly seen the concept that you can call something as equity only when fixed to fixed test is passed. Fixed to fixed test means what? One side of the coin, amount that is being paid to you by the investors, that should be fixed, and the number of shares that I'm going to pay, that should be fixed. Y amount of rupees from that side should be fixed. X amount of shares, sorry, X number of shares from my side, that should be fixed, correct? Then what is the sudden change over here? That's why I put this meme over here. Seriously? There is no logical conclusion why our Ind AS made a carve out point over here, because IAS 32 is absolutely correct. This is not a fixed to fixed test passing situation. It has failed. So therefore, in this kind of situation where your equity share value is already fixed in terms of rupees, and eventually the debentures, it's a foreign currency convertible bond. So therefore, rupee and dollar issue is that definitely the number of shares will be variable only. There's no doubt in that. You understand what I'm trying to say? So Ind AS 32 is absolutely correct. It should be classified as financial liability. But then, IAS 32 is 100% correct. It should be classified as financial liability. But Ind AS 32 says because issue price is fixed, it is equity. I personally feel that 90% this is due to some pressure from some of the big corporate giants in India. Probably these Mokku fellows have issued lot of FCCBs, and as a result, they would have pressurized our concerned authorities to, eventually classify this as a equity so that it will be better for them if it is classified as equity. If it is classified as financial liability, it will not, their accounts will not look good, their financial statements will not look good. Apart from that, I don't get any logical reason why there is a need to be a carve out point over here. That's the only reason I can find. I hope you guys can understand what I'm trying to say. Anyways, are we done with this? So, when it comes to the left side, it is quite clear, Nana, because one equity share is again represented in dollars. Your debenture is also represented in dollars. One debenture face value is $1. Therefore, for each debenture, you will be giving 4 shares no matter what. Therefore, fixed to fixed test is passed. This is an equity instrument. You got it? On this side, obviously, your equity shares is represented in 20 rupees per share in rupees, whereas your debenture is in dollars. So in future, if the dollar value varies, if the dollar value varies, automatically number of shares also will vary. Therefore, fixed to fixed test is failed. Therefore, this has to be a financial liability. But for our examination purpose, it's a carve out point. So therefore, you guys need to specifically remember that as far as Ind AS is concerned, because of lobbying from some big guys, it has to be classified as equity because the issue price is fixed, which is really a Mukku logic. All right, Nana. Is this clear for you? This point you have to specifically remember, Nana. Unfortunately, we can't apply the logic over here. We don't have a choice as well. Got it? All right. All right. Any other doubts with respect to this one before I move to next one? Puttable financial instruments. Till here it's clear. This concept is done. Foreign currency convertible bonds. Are we done with this? Chalo. All right, guys. Now, looking at the name itself, this will sound funny because puttable financial instruments. But anyway, that's the name it is. So in short form, let's call it as a PFI hereafter. Okay. So first of all, in the name itself, it tells you that it is a financial instrument. So there is no doubt in that. Okay. But it is something special. In what way it is special? Why the word puttable is used? Let's try to understand. See, basically, it's a kind of financial instrument where the holder of the instrument has got the right to put the instrument back. That is why it is called puttable financial instruments. Now you can ask me, sir, what do you mean by holder of the instrument gets the right to put it back? Put it back in the sense, who is the holder basically? Holder pays money to the company and then gets an instrument, correct? Now, saying that holder has got a right to put the instrument back means what? Again, I'll give that piece of paper or whatever it is, or electronic document or whatever it is, to the company back to get my money back. So basically, holder means I gave you money and I got some document. That's what happens in debentures or bonds and stuff like that. I give you money, you give me a bond, right? Saying that I'll pay you so and so interest these many years. After that, I'll do the redemption and stuff like that. So here also, when I say holder, even in this case of financial instrument also, he gave money and got the piece of paper. Let's say this piece of paper is something. Okay. But there is some speciality in this piece of paper which no other piece of paper has got. That is, debenture does not have this speciality, bonds does not have this speciality. You understand the point? So what is something special over here? This instrument, whenever the holder feels like, he can again put it back to the company, which means I give it back to the company and take the money whenever I want. I need not wait for 5 years to get the redemption. I need not wait for 10 years to get the redemption. You understand the point? But I can just put it back and get the money. That's why it is called puttable financial instruments, where you have an option to put back the instrument and get your money back. Got it? Chalo. Puttable financial instrument is a financial instrument that gives the holder the right. What is the word? Right. It is not an obligation. Please try to understand. Right means if you want, you can. If you don't want, you need not. The right to put, which means to give it back, to redeem or return, to return the instrument back to the issuer. Issuer means the company, for cash or another financial asset. Mostly it will be for cash. But because in the definition another financial asset is also there, but mostly it will be what, Nana? Cash. Right. Anyways, now this generally makes it a financial liability because the issuer has a contractual obligation to deliver cash. From issuer's point of view, it's a financial liability. Why? Because whenever I issue a debenture, I know that till 5 years, suppose after 5 years, I promise to redeem the debenture, Nana. I'm the company. I means I'm the company. I've issued a debenture. Till 5 years, I told that after 5 years, I'll redeem. In this 5 years, do I know that I need not pay any cash? After 5 years only, I have to pay cash. Or let's say it's a compulsory convertible debenture. In that case, after 5 years also, I'm going to convert that into equity shares. So nowhere, even this interest also, let's say it is discretionary. Then this becomes an equity instrument, correct? You got it? Coming on to puttable financial instrument here, I know that I gave a special, you know, right to the holder of the instrument. Whenever he wants, he can just give back that instrument and take the cash. In that case, I know that I have a contractual obligation to pay cash whenever that guy exercises his right to what? Put the financial instrument back. You understand the point? In that case, when you have a contractual obligation to pay cash, whenever the holder thinks that he has the right to put back the financial instrument and get the money from the company, then you will call it as a financial liability, obviously. That's what we have written here. Okay. However, here comes the twist. Ind AS 32 provides an exception where certain puttable financial instruments, not all. What is the word? Certain means some of them. Not all puttable financial instruments can be classified as what? Equity, despite having this repayment obligation. Puttable financial instrument means you have a right to put it back, therefore you have the repayment obligation. We know that as per the definition, whenever there is a repayment obligation, definitely you have a contractual obligation to pay cash, therefore it's a financial liability. There is no doubt in that. However, even having a repayment obligation, still despite having repayment obligation also, when it comes to puttable financial instruments, Ind AS 32 has made some exceptions where still it will be classified as equity. How, sir? It goes very much against the definition. Yes, it goes very much against the definition because it's a special case. What special case, sir? You will understand now. I've already written here, see, logic. Why is this exception required? Why Ind AS 32 treats puttable financial instruments in a special way? You know that the very nature of puttable financial instrument is to put back the instrument. When you're putting back the instrument, there is an obligation on behalf of the company to pay the cash. When there is a contractual obligation on behalf of the company to pay cash, there itself the point is clear. It is a financial liability, no doubt. Even then, Ind AS 32 says that no, in some cases it will be classified as equity. Why? That's what we're going to see right now. Let's try to understand. Now, I want you guys to focus. Normally, any financial instrument redeemable at the option of the holder is a financial liability. This we have already seen, correct? Did I write anything special? No, this is something that we have already seen, isn't it? Fantastic. But in certain cases, what are those certain cases? Now keep this in mind. Mutual funds, cooperative societies, partnerships. What is common among these three names? You guys tell me. Mutual funds, cooperative societies and partnerships. They don't have share capital like normal companies. You understand the point? Then how will you decide the residual interest? In normal typical companies, residual interest means the moment the name that comes to your mind is equity share capital, equity shareholders, correct? In a normal company. But in case of mutual funds, who are the persons who are having residual interest? In case of cooperative societies, in case of partnerships, that's what we're going to discuss. The residual interest in the entity is often structured as puttable instruments. Now you get it. How equity share capital for a normal company, they will have the residual interest. Similarly, when it comes to the so-called mutual funds, cooperative societies and partnerships, the so-called residual interest in the entity is often, this is also not in all cases, but often, most of the times. Okay, some people, they also call it as often. That's fine. Pronunciation is fine. Okay. So often structured as puttable instruments. Now you can understand what is puttable instruments. When the residual interest is being structured as puttable instrument, it is only logical on behalf of Ind AS 32 to classify that as equity in certain cases. Now it sounds logical. Still we'll discuss further. Now see here. Because these entities do not have traditional share capital, I've already discussed. which do not have traditional share capital, the so-called MF, mutual funds, cooperative societies, and partnerships. Okay. Ownership interest or redeemable on demand, but they still represent residual interest in net assets. Ownership interest or redeemable on demand means what? That's what puttable financial instruments, where on demand, whenever I have a right as a holder, I give it back, I get the money. But they are still representing what? Residual interest in net assets, just like equity shareholders in case of a company. So to avoid misclassification of such ownership interest as liabilities, because when you're having an ownership interest, I cannot classify you as a liability. That's why Ind AS 32 allows an exception, despite having an obligation to pay cash. Now again, don't come up with an argument saying that, sir, when there is an obligation to pay cash, it should be classified as financial liability, as everybody knows. But when it comes to puttable financial instruments, it is an exception. Why? Because puttable financial instruments in some special case scenarios, it acts as a equity shareholder who has residual interest in the company. Not in the company, we are talking about mutual funds, we are talking about cooperative societies, we are talking about partnerships. In these kind of different organization, puttable financial instruments holders has got residual interest in the company. Therefore, you have to treat them on par like equity shareholders in a normal company. Therefore, even though I have an obligation to pay cash, wherever the puttable financial instrument holder decides, has got right to put the instrument bank and get the money on its behalf, or any other financial asset on its behalf, still in some cases I will classify the same as equity instrument. Only in this case. Otherwise, whenever you have, in all other cases, when you have a situation where you have an obligation to pay cash, where you have a contractual obligation to pay cash, it will 100% be classified as financial liability, except in this case. In this case also, in all the cases, it's not going to be classified as equity, only in some cases. What is that? We're going to see. So conditions for exception. Just like that, even in this case also, Ind AS 32 did not say, okay, puttable financial instrument, classify it as equity instrument. No. Because puttable financial instrument means in all the cases, you have to pay what? Cash, whenever the holder demands. Try to understand what I'm trying to say here. See here. Puttable financial instrument. What is the basic nature of it? The company or any organization who gives this puttable financial instrument has got a obligation to pay cash. Okay, contractual obligation to pay cash. So the moment you see this sentence, it should be classified as financial liability per se, straight away, without any discussion. But Ind AS 32 says no. Despite having contractual obligation to pay cash, whenever the holder of the puttable financial instrument puts the instrument back, you have to pay cash. Even then, in some cases, this will be treated as equity instrument. Got the point? In what cases you will treat this as equity instrument despite having contractual obligation to pay back? Now, for that, first you have to see that this happens in certain organizations, mutual funds, cooperative societies, partnerships. Even in these organizations, the ones who has got residual interest are referred as puttable financial instrument holders. Okay. Even in this case, in all the cases, it will not be classified as equity. If certain conditions are satisfied, then only puttable financial instruments in cases of mutual funds, cooperative societies, and partnerships will be classified as equity. Now, what are those conditions? That's what we're going to see now. Okay, to remember this, use this Nana. Pick me in college now. Usually, I don't give these kind of shortcuts. But anyway, pick me in college now. PMINCN. Pick me in college now. Okay. What is P? Pro rata share of net assets. That so-called puttable financial instrument should satisfy this condition. Pro rata share of net assets. Proportionate. Most subordinated. Most subordinated means out of all the instruments that a mutual fund gives, puttable financial instrument should be at the last position. Last position in the sense, you take a company. Company issues debentures. Company issues preference shares. Company issues equity shares. But who is the most subordinate out of these three? All equity shares only, na? Because the least preference is given to equity shareholders. First you will pay to debenture holders, then you will pay to preference shareholders, then only you will pay to equity shareholders, correct? So which means who is the most subordinate of all these three? Subordinate means you are at the lower level, right? Equity shareholders. Similarly, even in case of mutual funds and stuff like that, the so-called puttable financial instruments, which we are discussing right now, should be the subordinate of all, which means it should be at the last position. Clear? Identical terms for all holders, so there should not be any speciality. 1,000 holders are there, same terms and conditions for all the holders. Holders of what? Holders of puttable financial instruments. No other obligation to pay. Any other special obligation should not be there. Only the right in the hands of the puttable financial instrument holders, where they can use that right, put the instrument back and get the cash. That's all. Cash flow depends on performance. No other instrument restricts the returns. If these conditions are satisfied, then the so-called puttable financial instrument can be treated as equity instrument, despite having an obligation to pay cash whenever puttable financial instrument holder demands his right to put back the instrument and get the cash. Despite that condition, despite there is a possibility of contractual obligation to pay cash in future in the hands of the puttable financial instrument holder, despite that, if these conditions are satisfied, that so-called puttable financial instrument will be still classified as equity instrument and not financial liability, which usually it should be classified as financial liability, but not in this case. Ind AS 32 gives you that exception. You got the point? But for that, you need to classify, you need to satisfy these 6 conditions. How to remember that? Pick me in college now. So pick me in college now. So P stands for pro rata share of net assets. M stands for most subordinated. I stands for identical terms and conditions for everybody. N stands for no other obligation to pay. No other obligation to pay apart from this one obligation. Got it? Next, cash flow depends upon the performance, right? Performance means of that. In mutual funds, it depends upon whatever the portfolio of assets where these mutual fund guys have invested in. You got the point? It depends upon the performance only. You'll have a cash flow, and no other instrument restricts the returns, right? Now let's try to understand this in an easier way. Sir, so far we have seen the explanation for puttable financial instrument only, na sir? Yes, sir. But now I'll try to explain it in an easier way with the help of an example. Okay, let's go with an example, Nana, so that you can understand it easily. You guys are ready? Now, this example will make you understand the concept in much easier way. Say, for example, you had any small doubts so far, that also will be cleared. Now, try to understand this. That is the reason I've specifically written this again. Now, see here, imagine, okay, you invest money in a mutual fund. Why mutual fund? Because those are all the 3 organizations that we have seen: mutual funds, cooperative societies, and partnerships. Okay, imagine that you invest money in a mutual fund. Okay, the fund gives you units. That's what mutual fund does, right? So I'll try to explain in a very simple way. This is mutual fund, this is you, okay, and this is the assets. Assets means the shares in which they are investing, the portfolio. Okay, so he takes money from you. Like that, millions of people will be there, not millions, let's say in lakhs, and then all this money will be pooled and then it will be invested. You understand the point? While investing, this entire asset will be divided into something called units, and then for how much amount you try to invest, for that respective units will be given, and that units will represent some amount of investment in the so-called assets. Okay, once you get the return, that return will go to the mutual fund. In that, they will keep some charges for them because they have provided all these services, and the rest will be transferred to you based on the number of units that you own. Clear? This is a very basic, bare understanding. Okay, bare bone understanding. Now, so if you invest your money in mutual fund, the fund gives you units. To only explain you this sentence, I gave you this example right now, this understanding. And you can return these units. And you can return these units any time and get your money back based on net asset value, NAV. You understand the point? This so-called feature of returning these units and getting back your money anytime is nothing but that's what makes it called puttable financial instrument. The right to return the unit is called a put option. You can put it back, and that's why it is called a puttable financial instrument. Got it? Now you got clarity once I gave you an example. I think now your understanding should be better. Okay. Now, example to understand the conditions. This is an example which I gave you to understand what is a puttable financial instrument. Again, I gave you another example to understand these conditions, because right now if you look at these conditions, it might look a tad bit strange for you. Okay. Right. Now see here. Let's say a mutual fund issues 1,000 units. Okay. Everyone can redeem their units anytime. Redeem means you can put back those units and get the money. But these units, the so-called units which mutual fund has given to you because you have invested money in mutual fund, don't promise any fixed return. Definitely it should not be a fixed return. You understand the point? It varies because they also invest in portfolios of shares, na? So it will vary for sure. Just give you a share of profits. Share of profits means what is profit here? They invest in a portfolio of shares, na? That shares will give return, na? From that return, whatever these guys cost, once they deduct that, whatever is left over is the profit. In that, you will get a share based on number of units you own. In that, you get share based on number of units you own. If you listen to this sentence, in that you get a share based on number of units you own. How does it feel like? Just like an equity shareholder in case of a company where you get a share of the profit once all the other expenses are taken off. You understand the point? Now you are able to relate both. Everyone has same kind of a unit, so there are no special units. That is one of the condition here, na? Identical terms for all holders, right? Units are the last ones to get money if fund shuts down. Same, company shuts down, who will be the last people to get money? Equity shareholders. Here also unit holders are the last ones to get money once the fund is shut down, which is nothing but most subordinated. Most subordinated means you should be the last to get the money in case our company shuts down. Here we are talking about mutual fund. Same happens in case of a company also. If company shuts down, the last people to get money will be the equity shareholders, only after paying to everybody else. Correct? Now are you able to link? If all these above conditions are satisfied, then redeemable units are equity, not liability, as per Ind AS 32. Even though this is a puttable financial instrument where you have a right to return these units and get your money back, means the mutual fund has a contractual obligation to pay you cash. Despite mutual fund having contractual obligation to pay you cash whenever you have a right to return, despite that, I classify this in my books as equity. That is a speciality, that is the exception. Because whenever I have a contractual obligation as a mutual fund to pay you cash because of the puttable financial instrument which I gave you, usually I have to classify that as a financial instrument in my books. But I don't do that. Why? Because if I satisfy these conditions, pick me in college now. If I satisfy these conditions, then Ind AS 32 allows me to classify this as a equity instrument, which is an exception. So keep this in mind. You got it? Another example I gave you over here to explain you when these conditions are not satisfied. These conditions means these conditions. Pick me in college now. Okay. Preference shares with a put option. Is it redeemable at the holder's option? Fine. It provides fixed division. Fine. Have priority over equity holders on liquidation. This is not satisfying the condition. Why? Because our one condition is it should be most subordinated. Here you are having priority over somebody else. Therefore, condition is not satisfied. They do not qualify as equity because you have a fixed return, provides fixed division. Even that condition should also not be satisfied. Yes, most subordinated class is not. You are not. Why? Because you have preference over equity holders over here. Hence, it is a financial liability. Got the point? So I just gave you an example only to tell you when there will be a situation when these conditions will not be satisfied. When they are not satisfied, then obviously it will not be called as an equity. Got the point? That's it. I gave you summary over here. This, when you are revising, you can just revise it on your own. Okay. What is puttable financial instrument definition? And then all the conditions. Got it? Chalo. Okay, we are done with this, Nana. If you got any doubts, you can ask me with respect to puttable financial instrument. Okay. So I gave you an example to understand what is puttable financial instrument. I also gave you an example to understand the conditions. And also I gave you an example where these conditions are not satisfied as well. I hope this should be clear. Yes. Shall I move to the next one? If this is clear. Right. Finally, the last concept. Once we are done with this, we are done with Ind AS 32. Share swap arrangement. Okay. This is the last one. After that, we'll go to Ind AS 109. Okay. Once the share swap arrangement is done, then in the next session, we'll go and solve sums. So in next session, sums will be solved. After that, we'll start with Ind AS 109. Okay. Chalo. What is the share swap arrangement? Share swap is nothing but exchange, Nana. Okay, a share swap means exchange. Interest rate swap means also the same thing. One is having a floating rate, the other one is having a fixed rate. Both of them will exchange. That's all. We call it as a swap. You're swapping. Same stuff here as well. A share swap is when two parties exchange shares instead of cash. See, there are two companies, Nana, PK Limited and SK Limited. PK Limited acquires SK Limited. Usually what will I do when I acquire? I pay cash and then I acquire. But instead of paying cash, what PK Limited is doing is that I am giving my own equity shares to the shareholders of SK Limited. See, usually when you acquire, what you will do? I am acquiring your company SK Limited. So for your shareholders, whatever the money that they want, I'll pay the money and then I'll buy your company. That's what usually it happens. You buy the control of the company by buying the equity shares, by paying those equity shareholders money, correct? But here what's happening? I'm not giving you money. Instead, I'm giving you my company shares to the shareholders of your company as a consideration for your shareholders. You got it? And then I'm buying your company. Got the point? So this is what we call it as a share swap arrangement. Clear? Right. So why are we discussing when it comes to Ind AS 32? Very simple. Again, the same confusion. Should it be classified as financial liability or equity instrument? The same confusion. Got it? Okay. Now, so when it will be called as an equity instrument, when it will be called as a financial liability. That's what we're going to see right now. Okay. Just a second. All right. Now see, Anana. It will be classified as an equity instrument, the so-called share swap arrangement, provided if it gives residual interest in the net assets. Obviously, unless you have residual interest in net assets, you don't satisfy the definition of equity instrument, correct? Has no contractual obligation to deliver cash or other financial asset. Again, the definition of equity instrument is non-redeemable at holder's option, which means you don't have any cash obligation. Again, a definition of equity instrument. So indirectly, all the 3 points that we have seen is nothing but definition of equity instrument. In other words, if the definition of equity instrument is satisfied in this share swap arrangement case, then it will be classified as equity instrument. Now coming on to financial liability, the so-called share swap arrangement will be classified as financial liability if shares issued by the acquirer. Who is acquirer here? PK Limited is the acquirer. SK Limited is the acquiree. Okay. PK Limited is the one who is acquiring. SK Limited is the one who is getting acquired. Who is getting acquired is nothing but acquiree. SK Limited is acquiree. PK Limited is acquirer. Okay. Now, financial liability if shares issued by the acquirer are redeemable at the option of the holder or mandatorily after some time. So when you are given the option to the holder, you don't know when he will ask you to redeem. If he asks you to redeem, you have to pay cash. So you have an obligation to pay cash. Therefore, it's a financial liability. It does not satisfy the condition of equity. Therefore, it's not an equity instrument. It is a financial liability. Involve fixed returns. If these two conditions are satisfied, it should be classified as financial liability. If these conditions are satisfied, it should be classified as equity instrument. Nothing special over here. You're not learning 3 new points or 2 new points over here. This is definition of equity instrument points, which you already know. This is definition of financial liability points, which you already know. You got the point? Nothing really special. Okay. Now, let's get to the example. Now, see here. PK Limited acquires SK Limited. Instead of paying money to acquire the shares of SK Limited, PK Limited gives its own redeemable preference shares worth 10 crore. These shares are redeemable after 5 years at fixed amount. Now you people tell me, when I have given preference shares and it is redeemable after 5 years at a fixed amount, it means after 5 years as PK Limited, when my shares are getting, preference shares are getting redeemed, which means redeemed means I have to pay money, correct? So is there a contractual obligation for me to pay cash in future? Yes. In that case, this will be classified as financial liability. So company PK Limited has contractual obligation to pay cash in future. So these preference shares are not equity and is classified as financial liability. Everybody knows. Simple. We'll see another example. Suppose PK Limited issued ordinary equity shares, which is not redeemable. There is no fixed dividend as well. These shares do not involve any obligation for payment or redemption. So classified as equity instrument. Okay. Same Nana, Ind AS 32 logic by PKSIR. What is that? Form of the instrument called share is not enough. What matters is substance. Does it create an obligation to pay? Substance over form? So therefore, here, when it comes to equity shares, you should not be looking at the form only. The name might be shares, but if there is a payment of some sort of a contractual obligation to pay cash in future, then even though the form or the name is equity shares, you should be actually classifying that as a financial liability. You understand the point? Sometimes the name will be preference shares, but the dividend will be discretionary. Even the redemption will be at the option of the company itself. In that case, you don't have any contractual obligation to pay cash. In that case, even though the form, name is preference shares, still the nature, the substance is in the form of equity. Therefore, you'll classify that as an equity instrument. That's what we have seen. That's what the summary of all that we have discussed so far. That's why I've written here Ind AS 32 logic. Clear? This is the summary of everything that we have discussed. Okay, all the concepts. Anyways, is this clear, Nana? So what is a share swap arrangement, Nana? Basically, I try to buy shares of your company, right? Obviously, how will I buy? I have to pay money to your shareholders. Usually, I'll pay money and then I'll buy the shares. Thereby, I get control over your company. But instead of giving money to buy your shares from your shareholders, I give my shares. So, which means I'm using my shares as a currency. You understand the point? I give my shares and then I buy the shares of your company. That's what we call it as a share swap. So to buy your shares, I give my shares. Got it? So which means I'm using my shares as a currency. In that case, should I classify this share swap arrangement as financial liability or equity? Very simple. You try to see the definition of equity instrument. If that definition is satisfied, you will classify that as an equity instrument. If the definition is not satisfied, you classify that as a financial liability. That's all, Anna. That's a summary. Simple. Done? Clear? This is a summary of whatever that we have discussed so far. Okay, so when it comes to Ind AS 32, ultimately 2 points you need to remember. One, it's not about what usually happens. It's not about what most likely happens. It's about what can happen. Second, the entire Ind AS 32, all the concepts, it always gives importance to substance over form. Form is nothing but the name. Substance is nothing but the actual characteristic of a particular instrument. So by looking at the name, don't get deceived. Just because a name is equity shareholder or equity shares for that matter or equity instrument for that matter, it does not mean that always it has to be equity. Similarly, just because the name is preference shares, just because the name is debentures, doesn't mean that always it's a financial liability. It can be equity as well. So therefore, always look at substance over form. That's what we have learned so far. Clear? That's it. We are done with Ind AS 32. All the concepts, nearly 43 pages we have covered. Okay, concepts are done. 43 pages is done. Okay, so now we're gonna go in the next session, not in this session. In the next session, we're gonna go and we're gonna cover all the other problems. I think 12 or 13 problems are left over. That will be next session. We'll finish off all the sums, and after that, the next session will be going with Ind AS 109. This is where all the funda will start, and you guys also will be very much relieved because all the too much of theory that we have seen so far. Hereafter, there will be no more theory. It will be mostly problems. You can see it here. Straight away we'll start with sums, as you can see here. Okay, it will be problems, entries, ledgers and stuff like that. Got it? Chalo. Let's wind up the session.